The Hedgeless Horseman here again on April 25, 2022. This is just a follow-up video to the last video I did. And I mean, I think today was actually a perfect example of what I was talking about in the last video. Even though this is obviously just one day, and I mean, the cases I own are typically based on what I think is going to happen, or what they are valued now, or what value they have now, what I think they will be worth in the future, what I think will happen over, let's say, the next 6, 12, 24 months, and compare that to the price I'm paying right now. And typically, if it's a growth story where I think that they will just keep increasing the intrinsic value, I'm getting paid to wait basically, because if price stays flat and or even goes lower and value just keeps increasing, that's just the risk reward just gets better and better and better. And when sentiment finally turns, even if it's in 6 months, if it's tomorrow, if it's in 2 weeks, if it's a year from now, I will just make a lot more money because the pressure to the upside will just be the value to price gap will just keep increasing. So I get paid to wait. So I'm exchanging short term boredom, pain, whatever, to even greater returns in the future. And like today, for example, I mean, I picked up some Goliath because this is one of my highest conviction stories right now for family members' portfolio. That's up almost 12% just from the intraday bottom in one day, a swing of 12%. So the one who panic sold here, he lost out on 12% in one day. And I'm not saying it can't go down, but I'm saying it shouldn't go down. And again, if I have some arbitrarily put target price, whatever, or a value target, let's say, that's somewhere up there. That means that if I bought this low, I would get, let's say, 73% in, let's say, 6 months to a year. Whereas, and that's all obviously what this person gave away in that case. Because, I mean, since, in my opinion, the risks are chronically to the upside. So I'm assuming, every day juniors haven't bottom gets it closer to a bottom, just by definition, because no downtrend continues forever. Goliath is obviously not in a downtrend, but in terms of sector sentiment overall in the junior space. So risks are to the upside. So I am more willing to believe that any day might be the bottom, like a rally today, even though the negative sentiment is out there. I mean, like clockwork, every time gold is up and juniors are up, everybody becomes bullish. Everybody's talking about higher target prices. The gold bull is on, the mining bull is on. As soon as a down day comes, it's the exact opposite. Everyone is running around with hair on fire, talking about how shitty this sector is. I mean, it's just constant momentum trading thinking, basically. Constantly herd mentality. It's like I assume, because juniors are so cheap, that one of these days they will have put in a sentiment bottom for real. So any time, any bottom from here on out, I'm always gonna give it the benefit of the doubt. So I mean, who knows? Maybe today was the bottom for Goliath. Maybe today was the bottom for juniors. We have no idea. It's just that the risks are to the upside because a crash in the junior sentiment has already happened. So one of these days, if it were theoretically to be today, for example, this person, let's say, gave away a 73% forward return within 6 to 12 months, and the one who's, if said person buys back at the high today, for example, I mean, he missed out on almost 20% just from buying this low and buying back the same day. Now it can go lower, etc., but it's like like I pointed out in the previous video, buying cheap is an exponentially increasing opportunity. So if Goliath goes down here, and I expect the case is intact, that it will reach said point, maybe I'll have a 93% return in 6 to 12 months from this level. Obviously that gets, I mean, the longer it, I mean, I think Goliath has a lot of higher potential than $2 per share, otherwise I wouldn't like the stock. But it's like, you know, if you can see 12% swings, that just a swing like that may have massive implications. Absolutely massive implications. Like, take for example, if you bought this bottom, let's say assume the same, it's gonna reach this value level, that's 247% return. If you bought this high instead, that's around 114. So like 130% return difference from buying low versus buying a, you know, short-term high. SK Mining closed a gap here. Trading gap. Probably some people who just panic sold as well, obviously. If for a time there it was up around 6% from bottom, ended at plus, let's say, 4.22%. Yeah, I mean, again, it's like you see all these many bottoms here. So if you just bought at any bottom, let's say average level here, when it reached a high, you would be sitting at a 78%. If you sold all these lows, obviously you would be giving away at 78%. But if you bought back higher, let's say when it felt like, well, now the bull is on again, that's a 25% return. So you got beat by this person by threefold. Instead of a 78% of buying here, you got a 25% return going forward. So again, it's like the cheaper something becomes if the story is intact. The future returns goes exponential. That's why I refuse to sell an intact case, and I buy more the cheaper it goes. Because my belief is that these cases will on average be worth a lot more in the future. So this just keeps increasing. So I'm buying, and one of these days, this is going to be a bottom. So let's say whoever panic sold this low, for example. I'm not saying it can't go lower first before it goes higher, or that I can't guarantee that it will even go higher. But on average, for the stores I own. But let's say the one who panic sells here, obviously, probably pretty emotional. Let's say he buys back here again. That's just a 27% return, let's say, in the next, 6 months, whatever. But he who bought this low might be sitting at a 97% return from this level. Allure Resources also put in, kind of akin to some hammer candle. I mean, the CEO was buying around this level. So like within a day or a few days from the CEO buying, someone sold Allure down here. And Allure is up, it actually closed at around 4.49. So that's an almost 9% swing. And the same goes for this, since I think Allure is just going to keep on growing. As my base case, let's say, when it hits this, let's say, value trend, okay, from the bottom here, that's, let's say 75%, and whoever, bought here, it's not bad, but it's 62. I mean, there's simply, even though it looks like it's just, one day movement, but these kind of things add up. I mean, the difference from buying down here in early December, that's 73%. let's say you just waited 2 weeks and you bought in here, that's 32%. So I mean, it shouldn't be hard to explain why it's like why you can kick the market's ass constantly by just buying low in intact stories. And not every story will pan out. That's not the point, because you don't need a lot of stories to pan out. And then of course you have to be willing to sit it out, because let's say you have a growth case. They've made a discovery, etc. It's like Elora. Okay, let's say this might be one of the largest discoveries in last few decades. Okay, so let's say you buy here. Let's say you're right, but if you sell out here, for example, I mean the story hasn't even played out. So in order to, if just Elora works, let's say if just Elora works, and it just keeps on going higher, okay, you still would have to sit for let's say 1-2 years to get a, I don't know, multi bagger. I think it can go higher than this, but I should have used logarithmic. Anyway, it's like the whole idea is that some will be great success cases if you're hodling a growth story, but you have to also wait for it to play out. I mean, you can't get a multi-bagger if you hold a stock for, or you can't get a 10-bagger typically if you hold a stock for 3 months or 6 months. But if you hold it for 3 years and one ends up being a 10-bagger, that's going to pay for 9 other stories that went to zero. So you have to give it time for the case to also play out. And if the story is intact, again, depending on where you think the blue sky case is, if it's up, let's say it's up here, and it takes 1 to 2 years, and you were buying, let's say you were buying this low, that's 488%, basically gonna pay for 5 stories that went to zero. And if the other ones didn't go to zero, obviously you'd make quite a bit of money. But if you bought up here, that would be 354%, not bad at all. But the one who bought here got like 130% more. And 130%, that's not a small number. You could wait years to get just 130%, but this is in addition to what you would have gotten if you bought here, for example. So it's like, this is no time to mess around during sentiment bottoms, because the difference in future returns when something is cheap and gets cheaper are extreme. 350% here, 662% here. So again, it's not if you sell, and we don't know when the low is, but if you sell the low, etc., and wait for it to go up 5 to 100%, let's say you buy back, let's say it goes down here, but you're not buying back, and you're happy to have panic sold here and thinking, again, you're smart, and of course you won't have the stomach to buy in again because you already shown that you're a panic seller. So let's say it breaks out of this box consolidation, which I think, and then you buy here, for example. So you in that case would have 283% return. I don't think you will get it, because I don't think you have the mentality for it. But anyway, even the person that bought here would outperform you. And if the person who didn't panic sell here and it just kept on sliding, he was just buying more and more. So he was buying 600% future returns, and you got in when there was like a, let's say, 300% return. So he's probably going to outrun you in the long term, even though his portfolio might underperform for a while, and you're sitting there thinking you were so smart to have sold panic sold because price went lower, so you think you made a right decision. It's about the strategy and mentality. The short-term results and medium-term results, I have no idea what they're going to be, but as long as the case is intact, etc., and sentiment is low, the risks are going to be to the upside. So it has huge, extreme ramifications what you do during sentiment lows and panics, etc. And this is specific reach. This is actually the story I was alluding to in the last video. And I didn't get any fills, I think, at the very bottom tick, but it's like that's up 11% from bottom today. At some point it was up 13%. And again, let's say we have a $1 value target, for example. So from here, that's like 100. From the bottom here, the one who sold, he gave away 177%. And if he would have bought back just at the end of the day, that's 150%. So he gave away 27%. That's not a small number. That's not small at all. If you could compound your portfolio 27% per year, you would have extremely good long-term performance. So I'm just gonna keep saying this, and I'll keep saying this if this correction goes on for 6 months to a year more, and stocks go something like this, because just how cheap the sector is right now, and if some of these juniors go down 30%, they're gonna be, you're gonna see 600% at the next sentiment high. So this at sentiment lows is when mistakes are extremely costly, and that's when most people make mistakes, and that's why most people never ever will beat a market over the long term, because they look at short-term price movements or medium-term price movements. So if the one who panic sold here again thinks he's super smart, let's say Pacific Ridge actually slides, becomes extremely cheap instead of dirt cheap. He thinks he's so smart, but the ones who realize that it is dirt cheap and just went to extremely cheap just keeps buying. So it's like his future returns are just going up and up and up and up and up. A lot. Like a 10% decline in price. Who knows, maybe that'll add like 20-30% in future returns. So again, for the love of God, stop being irrational, and visualize that you might be in for let's say a 6-month correction in the future. Let's say it has juniors haven't bottomed. Let's say they won't bottom for 6 months. Realize that buying cheap is never a mistake. It's just delayed gratification, basically. Because the only way a trend in a negative trend in the junior sector continues forever is if the sector disappears. So what do you think? How likely does that seem? Not likely at all. Okay, so in that case, you know that when stuff becomes extremely cheap, there's a lot of room to the upside for when sentiment turns around, and the future returns are just gonna go absolutely exponential. And like I showed in the previous video, I've been down with my entire portfolio, my entire net worth, more than 50% multiple times. And it still, it still doesn't really matter. Because I just keep buying the best stories I can find at the cheapest possible price I can get them at. And when eventually the correction becomes an uptrend, you make a lot of money. And with time you'll make you can make an immense amount of money. So I'm just, again, trying to hammer home the fact that what you do at these lows have massive implications for your future returns. If you bought or sold this low, that's 470% to this high here, which was less than 6 months away. But if you bought back here when it broke up out of this top, that was 66% instead of 476%. So think about that. And of course, the later you buy in, that's going to be closer to the next down cycle. So this is when people prefer to buy. And that's why they're crying right now. And today was the first time I blocked someone. I haven't blocked someone in 2 years, I think. Because he was just basically whining. Do you think I think that person beats the market? Do you see me whining out there? No. I take responsibility for my actions and I know what's going on. Short-term or medium-term pain in an intact story means that future returns are just going higher and higher and higher. And the only thing that sucks is when you don't really have dry powder. But like I've shown before, you can shuffle within a portfolio. So let's say that this is one of the best stocks you know of. Another stock actually, another story you also liked, went something like this. But Pacific Ridge went down here, let's say. Let's say you're selling this to buy an even better story, even cheaper. That's opportunity arbitrage as I see it. So it's like with volatility comes great opportunity. If you have 10 stocks, you like them equally much, 5 of them are down 5%, 3 of them are down 10%, 2 of them are down 20%, then you can just shift from one to or several, or sell some of the ones that are down 5% to buy the ones that are up 20%, because they might have 178% return going forward, whereas the ones you sold will have 113%. Not that any of those returns are bad, it's just that you're converting a paper loss into a real loss that will cost you 113% going forward to buy something that will give you 177% going forward. These are base case scenarios and you can't guarantee, obviously, and as always, the cheaper something gets, the more attractive they become, all else equal. Because let's say you find your portfolio's gone pretty bad, but you find some stocks that have been absolutely hammered, and you think, well, I do think in the next 6 to 12 months, I think they're gonna, I think X is gonna happen, or X or Y or Z can happen, etc. So let's say they're equivalent of trading down here, and would give you a base case of 389%. You don't need to shuffle that much, because the expected returns in those few stocks that have been extremely oversold, let's say, they're gonna supercharge your returns. It's the same thing of, like, let's say you have a stock that's down 50%, another is down 80%. You like them equally much. Obviously, that's a huge opportunity arbitrage to sell the one, take the paper loss, convert it to a real loss at 50%, but you buy something that's gonna go up 380%. Or even more, who knows? I think, again, some of these juniors, think about it. This is, right now, the sentiment is absolutely atrocious. And there will be a time when sentiment is great. And I don't know what ounces in the ground will trade for at that point, but I can tell you it's going to be considerably higher than now. And let's say you buy a fast grower that adds 1 million or 2 ounces by that point. If it has like 300,000 ounces right now, is trading for $10 per ounce. Let's say they come up to 1.5 or even 2 million ounces. and ounces in the ground in the future will be valued at 50 to 100. I mean, you can see the leverage there. So if you're right on a growth case and time it with a sentiment bottom, I mean, there can be some ridiculous returns from a sentiment bottom like we're seeing now. It's just, yeah. And I know people get pissed at me for saying that I'm increasingly bullish, because like I think people are somewhat offended because they can't understand why I'm bullish, and a lot of people, I think, buy around the tops, and let's say they find me later and I'm screaming buy all the way down. So in their opinion, they found the sector. I should better to put up like GDXJ. Since I am a stock picker and am always long, so I'll be bullish my juniors at every one of these tops. So typically what I think is happening is that people buy these tops, let's say, and they maybe find my account, and and they see I'm bullish, and they see share price go down and down and down and down, and I'm just bullish, and then I hear you've been screaming buy all this time. The boy who cried wolf. Yeah, but I've been screaming buy from when I started, and increasingly so, like you've seen the amount of videos, etc. I've been doing lately, especially starting around here. And the juniors, this is the GDXJ. I don't even own GDXJ. I mean, I don't know what kind of candle this is, but it's like a fat gap and obviously a big tail here. That's what, again, people do wrong. They enter way after the bottom, then they get in, then they get dragged across the concrete for a year or two, and complain about people being bullish just in time to sell out before, let's say, the bottom is actually in. And then they buy back up here just in time for the next correction to come. It's like, this is not rocket science, but it's like drives me up a wall. It's like, if you don't like what I'm saying or whatever, it's like, I mean, I don't share your profits or your losses. I'm trying to be helpful. I mean, this is obviously, well, these are actually sponsor companies and I own them. So I'm of course talking my book, but at the same time, a lot of these videos are just to, provide examples how to think. I don't care what juniors to have. Because if you have the wrong mentality, it doesn't matter what junior you have. If you held on Great Bear and had the wrong mentality, you were never going to get that 20 bagger. So there's like universal investing truths, let's say, or common sense that is applicable to any story or any stock that you happen to own and like. I'm just using the ones I own and like as examples because those are the ones I know. So again, in short, the return difference from increasingly cheaper levels. You can see, I mean, the return here is like, it's like printing for future money by buying low. And I don't know if this is the bottom or not, but let's say again, let's say the next up leg in miners are going to take GDXJ to 84. So if you bought here, you were sitting in a 64% return. If you bought low here, that's like 30% more, which is absolutely great. An added 30% in let's say a year. That's superb results. And in the juniors, of course, it's typically a lot more extreme. I mean, assuming again, this is just a base case, theoretical target price, etc. I mean, you can see the future returns just ticking. So as long as a story is intact, I have no reason not to believe that the growth value trend will continue. And since we're at a sentiment low now, we're gonna probably overshoot the value trend like always happens. Maybe it goes up here and then down here and then up here. That's why growth stories combined with understanding sentiment is so important, because if you have a mature miner where the value gap, price to value gap is fixed pretty much, they can't grow much. I mean, Barrick has a very hard time growing, obviously, or any other big developed producer really. So if sentiment turns at this point in time, and you bought here, let's say, for the let's say it turns here actually. So in the mature and the growth case, the expected return will be 180%. But if it takes even longer, and I'm including dilution here, the growth case just keeps on growing. But the mature miner is still mature, hasn't grown anything. So let's say, okay, this is actually 1 year, but let's say 1 year and I don't know, yeah, exactly 1 year actually. Maybe the target price for the growth company is up here, and the mature miner that hasn't grown is down here. So even let's say the price just keeps on being neutral, you don't get paid to wait, because the expected return from this one in the mature miner is 180%. But the growth company has kept on increasing the value and was given no credit by the market. But when sentiment turns and said growth gets actually discounted, you would be making a 450% future return instead of 180%. That's obviously an extreme difference in future payoff. So that's why I like probable growth stories, because I, in my opinion, get paid to wait. If the share price keeps on sucking and the company keeps on growing, that means there's just going to be an increasing price to value gap that's going to be closed one day and probably overshoot as well. That's why I'm chill. I'm a stock picker. I look at the companies. Are the stories intact? Are the stories intact? In that case, all else equal, any decline in price is just a better buying opportunity. Simple as that. And that's why I, said sometimes that if I'm a bit, let's say, lazy or can't come up with what company I actually want to increase in, I just buy the ones that down the most. That's why I bought. Okay, now I actually removed the short for Pacific Ridge. That's why I bought Pacific Ridge. It was down 13%. It has no business being down 13%. It just raised money, closed the financing last week. And that went up 13% from bottom to top today. So if that was the bottom, that will have huge implications if you actually caught that bottom. And the one who panic sold that bottom would obviously be giving away, a ton of upside in the future. And Goliath, another one, since that was down, I don't know how much, but that one of my favorite stories. And I think I had some bids in at 26 or something. I don't know if they hit, but that maybe I got 9% from that just in one day. And if that was the bottom, getting in, it might not look like much, but that's going to have huge ramifications going forward. So my main point is, it's way more expensive to sell cheap than buy high. Because if you sell cheap when the future returns go absolutely ballistic, that's going to cost you a lot of money. But you can afford to buy high just as long as you increasingly buy low. And just keep doing that. Buy more here than you buy up here. Because the ones you buy low and the story is intact, their future returns are going to be absolutely ballistic in some juniors. And that's why I keep harping on this point. Obviously, I'm not necessarily helping myself, because I wanted to buy this cheap. But I don't have that much dry powder anyway. And sure, I do some shuffling now and then, but it's like that's all you need to know. It's like fear selling low a lot more than buying high. That's like the cardinal sin to sell bottoms, and that's why I absolutely hate selling 52-week lows, and that's why I've actually been picking up some micro cap stocks that are trading at the lowest level in like 2 years. So in 2 years, there has never been a point where you could buy them as cheap. And if you can buy them at the cheapest level in 2 years, that implies that now you would get the highest possible future returns in the last 2 years. It's literally that simple. The cheaper you buy, the more risk to the upsides there are, especially if the case is intact. Yeah, consider me biased. I own shares of all companies mentioned, I think. I don't own GDXJ. I am sponsored by Loro SK and Pacific Ridge and Goliath. So do your own due diligence. And again, it's like, do what makes sense to you. I'm trying to, educate people what has worked very well for me and what, in my opinion, makes more sense than anything else, more sense than watching macro or trying to trade gold or looking at the COMEX gold price or guessing what Fed is going to do with rates, etc. Because the companies are on a case by case basis, and the juniors haven't followed gold anyway. So that's like a moot point in my opinion. Thanks for listening. Bye.